Hello, this is Joe Pryor, the virtual real estate team in Oklahoma. And wow, what an interesting real estate environment we are with these mortgage rates that we have right now. They went up last week again. I mean, they've gone up about a half to 3/4 of a point in a little over 30 days. And so we're really dealing with some tough problems here in terms of trying to make investment properties work. We're having to work really hard to put the right house together with these current numbers. Now, eventually, interest rates are going to go down, but eventually can be 6 months from now, a year from now. We're not sure at this point. The economy is still fine. And normally, what I do when this happens is I say, well, next 2 or 3 years, things are going to look a whole lot better because rates go up, rates go down. They're taming inflation. It's a little sticky right now, but they are. And so what can we do in the meantime to give you really strong positive cash flow? And normally that's adjustable rate mortgages. Now what that means, what an adjustable rate or ARM mortgage means, is it's fixed only for a certain amount of time. It could be 1 year, 3 years, 5 years, 10 years. It stays fixed and then it adjusts and you have caps on the adjustment. Sometimes the caps can be 6%. So you start at 5, you may end up getting to 11. But here's the thing. Normally, I want to try to do like a 3-year ARM or a 5-year ARM. And the reason why I want to do that is because it gives you the opportunity to refinance. Now, I'm not a big fan of 10 years, and I'll tell you why. When you refinance, one of the downsides of refinancing is that you start over again. In other words, it's a 30-year loan when you refi. And if you've had 10 years already of paying down the principal, then you're literally starting over with 30. Now, that's not necessarily a problem. I mean, leverage is not necessarily a problem, but it's something we want to make you aware of. But back to the ARMs. Why aren't we doing ARMs right now? That sounds logical. Well, we got this weird thing called an inverted yield curve because ARMs are based on lower treasuries. Normally, we associate 30-year mortgages with what 10-year treasuries are. And right now, the thing is that it's an inverse curve. And so 3 years, 1 year, 5 years are in the wrong direction. And actually ARM rates right now are worse than a fixed rate. So it doesn't make any sense. So normally what I'm telling people right now is, a lot of this is going to be neutral, maybe slightly positive cash flow, but prices are going up in the meantime and they keep going up. And people keep buying houses no matter what the interest rate is right now. Oklahoma City and Tulsa market is a seller's market, and a lot of markets are that way. So normally what I'm telling people now is if there was an ARM rate that you could get at 5.5% or 5%, man, I'd be all over it. Right now, go with the higher rates in the 6s and refinance in the next 2 years because you're going to lose a lot of ground at that point, and you're going to have about 10% more value in your home, which is going to allow you to refinance and roll your cost into that, so no money out of pocket. So right now, that is the way the market is going to go. Unfortunately, ARM rates make no sense at this point. You need to stick with a fixed.